All right, hi there, guys. This is Professor Hildebrandt. This is the first of a three-series lecture from Chapter 6 from our macro text with McEachran. This chapter focuses on, it's called Tracking the U.S. Economy. But so in those three parts, in the first part, this video, we're going to cover in more depth GDP, or Gross Domestic Product. In the second one, we are going to look at our circular flow model that kind of really paints a picture of how all the pieces of our macroeconomy work together. And then in the last one, we're going to talk a little bit more about inflation and talk about the CPI, or Consumer Price Index. So again, after you watch this video, please go through and watch the next two as well. So GDP, Gross Domestic Product. This is one of the most important measures that we have for a macroeconomy, okay? We define it as the market value. So think retail sales price, okay? So market value of all final goods and services that are produced in our economy during a given period of time. We definitely report this on an annual basis, but we also look at GDP by quarter, GDP by month. So there's a lot of different time measures that we can use. So some important things, we're going to kind of break down this definition a little bit more. One thing is that location matters. So it matters where our resources are. So for GDP, in order for that production to count, those resources have to be located in the United States, okay? So give you an example. Obviously, if there's a Ford plant in Michigan, then that counts towards the U.S. GDP. But we happen to have here in Georgia a Kia facility where they are producing final cars. The production of those Kia cars, because the resources are located within the United States, also counts for U.S. GDP. Let me give you a couple of examples of what doesn't count then. So for GDP, if Ford has a facility in Argentina and they're completely manufacturing those trucks down in Argentina and selling them down there, that does not count in U.S. GDP. Why? Because the resources are located outside of the United States. So that's GDP. This next guy over here, you probably don't hear as often, but it's another way we can measure production. It's called GNP, or Gross National Product. And for GNP, it doesn't matter where resources are located. What matters for this one is resource ownership. So who owns the resources? Okay, so for the Kia plant that is here just outside of LaGrange, Georgia, those resources are owned, a lot of them at least, by a foreign company in another country. Those do not count then, that production, in U.S. GNP. GDP, yes. GNP, no. Okay, so that's how we distinguish the difference. GDP is looking at the location of resources. Gross national product is looking at the ownership of resources. So now if we go back to a Ford plant in Argentina, that would count for GNP. Okay, so this is a very important equation. And over the next couple of chapters, well, really till the end of the term, we're going to have quite a few formulas, so you need to be keeping track of these, okay? So this is our equation for gross domestic product. I'll break it down in a minute, but it's consumption spending by households, investment spending by firms, government purchases, and then net exports. Another important concept for GDP is that one person's spending equals someone else's income, right? You go to Walmart, make a purchase. Part of what you spent is then a wage earned by the stock guys and the cashier and the manager, okay? And then they take their income and they buy things. Okay, so we'll talk more about that. So what that's going to mean is when we're going to try to quantify, give a numeric value to our GDP, we're going to have two methods of doing that, okay? So I'll talk more about that in 1 second. But first, let's look at this word right here. Market value of all final goods and services. So we need to distinguish what is a final good and what is not. So let's talk about final versus intermediate goods. A final good is sold to a final end user. An intermediate good is purchased by firms and then it's transformed in some way and resold. Now, the important thing here is the same good could be either final or intermediate. It all depends on the purpose of the person or firm who is making the purchase, right? So let's take a pack of chicken, raw chicken. So what if I buy some chicken and I take it home and I cook it for my family? Then it's a final good. I bought it, I cooked it, we ate it, product life cycle has ended. However, if Chick-fil-A, the retail chain, purchases raw chicken, they're then going to bread it, fry it, put it in between a warm toasty buttered bun with a couple of pickles, and they're going to sell it to someone else. So for Chick-fil-A, the chicken represents an intermediate good. So the important thing here, though, is only final goods count for GDP. Okay, intermediate goods do not. And the reason is we're trying to avoid what we call double counting. Remember, we want gross domestic product to be a measure of production. What did we make this year? What did we make this quarter? So if we counted that chicken when Chick-fil-A bought it, and then we counted again the value of the chicken when I buy their sandwich, we would overestimate what the chicken represented in terms of production. Because of this reason for double counting, we also don't include the resale of any used items. Okay, so I bought a new to me car in February of 2019, but it was 1 year old. It was a 2018 Acadia. So it didn't count in the U.S. GDP for 2019 because the value of that car had already been counted the previous year. Same thing with homes. Only new construction counts. The resale of existing homes does not count. So again, because one person's spending equals another person's income, we're going to have two methods to calculating GDP. The first we call the expenditure approach, where we just add up all the spending. And that's where we're going to use that formula that GDP equals C plus I plus G plus NX. And then we're going to use an income approach. So all the earnings from those who produce the output. And I'll show you a method for that here in a moment. So first, the expenditure approach. Again, there's the formula you need to be familiar with. You also need to know that this is also the same thing as our aggregate expenditure formula, which we'll use later in this class. And then also going back to chapter 5, this is also what consists of our aggregate demand for our overall macro economy. So let's break down these pieces then, because they're really important. So the first is consumption spending by households. That's our C. So it's all household purchases of final goods and services except for new construction on residences. That counts down here in investment spending. Okay, see it right there. So that's the biggest part of our GDP here in the U.S. I think, when did this textbook come out? I think these numbers might have been as of 2016. Consumption spending was 68%. Okay, so almost, 2/3. A good bit of our spending is all from households. The second part then is by our firms. So investment stands for gross private domestic investment. but it's basically what are firms spending money on. So it could be new capital goods, that physical capital like new fleet vehicles, computers, machines, buildings. It's also, again, new residential construction, so there is a little bit of household spending down here. And then also net additions to their inventories. This accounts for 16% of our overall GDP. Next, we move to government purchases. So this is spending by all levels of government, excuse me guys, for all goods and services. And as of the time that our book was published, this was 19% of GDP. Now, what do we see during a recession? Well, during a recession, we see consumption spending decrease. And it mainly decreases because investment spending decreases and firms lay off people. They don't have income, and so then consumption spending decreases. So going back to the previous chapter, this is where Keynesian economics would come in and say, okay, government, it's now your responsibility to increase your spending to get our economy kind of moving again in a forward direction. Our final category for the expenditure approach is net exports. Again, another simple formula you need to know. Net exports is exports minus imports. This category can be both physical items. So I could purchase some, order online some wine from Italy, and it gets shipped over here to me. Well, that's an import to the United States. That's a physical item. But it could be intangible things. So, someone could hire me to work as a consultant on a project for a company in another country. That would be a service, and it would be an export. Okay, my services were leaving the United States. For the U.S., our net exports tend to be negative. We're about negative 3% of GDP, and that's just because we import in more than we export out. All right, so in this chapter, I'm throwing in a few little questions to try to help you guys review as we go through our concepts. So take a second and think about this one. Which of the following is an example of a final good or service? Remember, what is the purpose of the one purchasing it? So A, a cup of coffee bought at a restaurant. B, flour purchased by a bakery. C, the used car that John bought. Or D, bricks purchased by Bob, who is a contractor who builds new homes. So pause this for a moment and think about your answer before I explain this. So I'm going to start with B, flour purchased by a bakery. So we would classify this as an intermediate good. The baker needs that flour to bake her cookies, cakes, etc. So the flour, in terms of its value added, doesn't count until the final cupcake is sold to my daughters. For C, the problem with C is that the car that John bought was just like the one that I bought. It was used. And so the production of that vehicle has already been counted, and we're trying to avoid double counting. Let's look at D here. Yes, obviously I skipped over the right answer. So for D, bricks purchased by Bob. Well, what's Bob going to do with them? Well, then we learn he's a contractor who builds new homes. So again, this is an intermediate good. So that would leave our final answer as A cup of coffee that I buy at a restaurant. I drink the coffee. The product life cycle ends. This is a final good. Let's try one more. We have a hypothetical country, and here are our numbers. Consumption spending is $2,000. Investment is $600. Government purchase is $500. Net exports are minus $40. And transfer payments equal $340. So we're asked to find what GDP equals. Again, in a second, I want you to pause and try to work this out on your own before I do it with you. However, let me give you a warning. When you have these economics questions, sometimes, you guys are like, oh, the professor is trying to be tricky. It's not that. But how easy would it be if I simply give you the 4 things that are in the formula for GDP? So you're going to often see things that aren't included in GDP. And so part of answering the question correctly is me understanding that hey, that's not part of GDP. So look out for those things. Pause this video now, please. Okay, so for GDP, this is obviously using the expenditure approach. So I'm going to write down my formula. GDP equals consumption spending by households plus investment spending by firms plus government purchases plus net exports. Okay, so let's find my numbers. So C, here's my C, so 2,000. Investment I, here's, oh, I've already flipped ahead. Sorry, the side of my hands progress my slides forward. G, government purchases, here's my G, 500. And then net exports, and we're told that's minus 40. So negative 40. Okay, and be careful because the question may not have given you net exports. It may have given you like exports equals and imports equals. So maybe it said, you know, exports equals 100 and imports equals 140. And then you would have to know that net exports is X minus M, and that's where you would get the minus 40, okay? Now, yes, we have this transfer payment, and so often students are like, oh, well, she gives me the number, I must use it. No, no, no. Transfer payments are not part of our GDP equation, so we're going to ignore that. And so if we add this together, 2,000 plus 600 plus 500 minus 40, well, 600 and 500 is 1,100. 1,100 plus 2,000 is 31. And then we subtract out the 40, and our correct answer is, sorry, I'm going the wrong way, 3060. So we would have $3,060 is our answer. This is not the right answer, okay? That's, I missed a minute error when I was putting this together. B is our correct answer, okay? Because again, we're just adding up the 2,000 plus the 600 plus the 500 to get 3,100, and then we're subtracting out 40. So our answer, excuse me, y'all, is 3,060. Oh, that's what I was sorry. I didn't go far enough. Okay. So there we go. Oh, I'm so sorry. Okay, so our second approach to GDP is called the income approach. And here we're just adding up all earnings of our resource suppliers. So we talked about different types of earnings in chapter 1. So these coordinate with different resource types. I'm not going to go through those again, but you can look back at chapter 1. And again, because one person's spending, expenditure, equals another person's income, these both will give us GDP. So for our second method, the income approach, we're going to do what's called value added. And so to calculate our value added, we're going to take the selling price of a product, and we're going to subtract out the cost of the intermediate goods that we purchased from other firms to transform into a final product that we sell, okay? And so that will give us the income earned at each level of production, okay? That's what we're looking for here. Once we have the income earned at each level of production, we will then sum up all of those to get to the total value added. Well, this is a little bit blurry, but let's work with it. So we're trying to calculate the value added for a new desk. Okay, so here we go. All right, sorry. Kids are interrupting me. So we start with a logger cutting down the trees. And we're going to assume, you know, he inherited this land, there was no cost. And he's going to sell this log that he cuts for $20. So this first column here is where we put in the sales value. Column 2 is where we would put the cost of the intermediate. Again, for the logger, it's just 0 right there. And then to get to column 3, the important one, the value added, you just take the column 1, 20, minus column 2, 0. And so right here, we have $20. Well, then the miller is the one that purchased the log, and he's going to grind it up. So he's going to sell it for $50, It cost him 20. How do I know that? Well, the cost of the intermediate good in the second step of production is simply going to be the sales price in the previous. So now that I know that the miller is selling it for 50, watch what happens. That becomes the cost for the manufacturer in step 3. So back to the miller. His sales price is 50. His cost of intermediate is 20. So 50 minus 20, $30 value added by the miller. Then we'll look at the manufacturer who sells the desk to the retailer for 120. So that becomes the expense in our last step. 120 minus 50, $70 added. The retailer is going to sell me the desk. Maybe I want a desk at my house. So I'm going to buy a desk for $200. It cost the retailer 120. Value added was 80. We add these up. The market value of the final good is $200. And you may have already noticed this. If there's no cost of intermediate in step 1, then the sales price in the final stage will equal the total value added. Now, some of you may be thinking, well, that's easy. I won't have to do all these steps. I'll just look at the final sales price and I'll know how much value was added. And while that is true, again, as long as there's no cost of intermediate in stage 1, but most likely that's not the question you're going to be asked. I can ask a lot of different questions with this information. So if you're presented a word problem with all these numbers, I would make myself a chart and list it out, okay? But again, what other kind of questions could I ask? Well, I could ask, who added more in value, the miller or the logger? And you would say the miller because 30 exceeds 20. Or I could ask, what was the cost of the intermediate for the manufacturer? And in that case, your answer would be $50. So let's test out what we've done so far. Jimmy, a farmer, sells 20 worth of peanuts to a factory that manufactures peanut butter, which it sells for 35 to a retail grocer. The grocer then sells the peanut butter to 10 customers for a total price of $100. Which of the following is true? See, I'm not just asking total value. So again, I would, I should have put another slide in here so I have room to write. But I would make out a chart, right? And so I would start with my chart. Let me see if I can kind of make it fit up here. So I have my farmer, and he sells $20 worth of peanuts to a factory. So factory would be stage 2. We're not told there's a cost, so I'm going to say my cost is 0. And so then my value added by the farmer is 20. Okay? The manufacturer sells it for 35 to the retail grocer. So we have the grocer. And so 35 is the sales price. Cost of the intermediate for the factory was that $20 from stage 1. So value added is 15. The grocer then is going to sell for $100. Their cost was 35. And so their value added was $65. My total then, value added, I'm going to go ahead and calculate that just in case I need to know it. 65 plus 15, so that's $70, $80, $100. Again, I told you it would match the retail price in the final stage because there was no cost in stage 1, and it did. So A says the total value added is 65. Well, that is not correct. Our total value added was 100. Okay. B, the factory adds more in value than the farmer. Well, is 15 greater than 20? No. 15 is less than 20. So B is not true. The market price of the peanut butter is $120. How do we find the market price? The market price is simply the sales price in the final stage. That is not true either. The sales price was $100. D, the grocer adds more in value than the factory. Well, is 65 greater than 15? Yes, it is. So that's our final answer, D. So that's how you work a value added question when it comes to calculating GDP. Okay, my last part about GDP, and then I'll move on to my new videos. So there are some limitations to GDP. Yes, it is a good measure. We do use it a lot to look at the overall health of our macroeconomy, but it's not perfect, okay? First limitation, some production isn't counted. So every country has what we call an underground economy. These are market transactions that are not officially reported. Why? They're either illegal. So like in the United States, other than a few exceptions, the buying and selling of marijuana is prohibited. So those transactions go unreported because they're illegal, right? Gambling, again, outside of a few different places in certain states, it's not legal. So anything that's an illegal activity is going to be unreported, because otherwise there would be a criminal process. Okay. The other reason could be that people want to evade taxes, and some of that is the illegal kind of taxes, right? They're trying to do tax evasion, but some of it is just hey, I paid Johnny $20 to cut my lawn. Johnny's not going to claim that on his taxes. He's 15. He's not even going to file taxes. I'm not going to put that as an expense on my taxes and make Johnny pay taxes on it, right? He's just a neighbor kid. I'm trying to help him out, give him a little bit of gas money for his car maybe. He's helping me out because I don't want to cut my grass, right? Same thing if you hired like a babysitter or something like that. It's estimated, though, that for the U.S., about 10% of our GDP is unreported, or equal to about $1.6 trillion. So this is not a small amount of money. The second reason that GDP is not a perfect measure is because it fails to measure things like leisure, quality, and variety. So what do I mean by that? So in the United States today, the trend has been compared, especially for men. If you look at men back in the 60s and 70s, and the age at which they would retire, they almost worked till death. I know that sounds awful, but they would work, finally retire, and then pass away within a couple of years. People now in the U.S. Tend to have much earlier retirement dates and live a little bit longer. So we have a lot more leisure time. A lot of people, too, aren't working more than, an average 40-hour work week. And so we're enjoying that more quality leisure time. But remember, what is GDP measuring? Production. So if we're spending more time with family, taking more vacations, retiring early, that's not captured in GDP. Better quality. So I can remember when my dad purchased my mom her first cell phone. It cost several $100s. It was the size of a brick, and it was useless. She pretty much never had cell service. It couldn't do text messages. It couldn't get on the internet. You basically would call my mom's phone and leave a voicemail, and then when she got back to a regular landline, she would call you back. So if I go out today and buy a $400 cell phone, in terms of GDP, those products are the same. $400 phone in 1996, $400 phone in 2021. But you and I both know those phones are in no way the same, right? In terms of the quality, that phone that I'm carrying now, as a matter of fact, it's better than the first computer my parents bought back in the early 90s, okay? So GDP is not capturing those improvements in quality. And then greater variety, right? For the most part, we tend to have a lot of variety when selecting the goods and services that we want to purchase here in the U.S. And so GDP is not really capturing the depth of the variety that we have either. The third reason and final reason is that GDP doesn't reflect all of the true cost. So we mentioned this term back in chapter 3, externalities. And in this case, we're going to look at the bad ones, the ones that we would wish we had less of, okay? Things like pollution. So if production causes air pollution, water pollution, soil depletion, we cut down all these trees and we don't replant them, that's a negative impact for our environment and for our society as a whole. But GDP is just calculating that market value of what we produce. So it doesn't take into account these negative costs, like pollution and the depletion of our natural resources. Okay, guys, that's all I have for part 1 of chapter 6. Stay tuned for more where I talk about the circular flow model and CPI.